Okay, let's unpack this. You know that feeling when you try to get a handle on investing.
Hmm.
You open an app, check the news, and it's just, well, chaos.
Yeah,
Prices jumping, predictions flying, um, a million different opinions. It feels almost impossible to know what's really going on.
it really does. The market just throws so much noise at you every single day. Headlines, rumors, these short-term ups and downs that are, purely driven by emotion.
Right.
It's like trying to understand the weather by just looking at one raindrop.
Yeah, exactly. And when you're trying to figure out what a company is really worth, underneath all that daily drama, how do you even begin?
Well, that's the core question, isn't it?
How do you find those opportunities the market might be completely overlooking right now?
How do you cut through all that temporary stuff, the noise, and focus on the fundamental, you know, the long-term reality of a business?
And that's exactly what we're going to do today. We've gathered up this stack of sources, and we're taking a deep dive into the world of value investing. It's this approach that's all about figuring out what a stock is truly worth
Mm-mm.
and only buying it when the price is like significantly less than that worth.
So we'll start with the core ideas, the kind of philosophy behind value investing that helps you tune out all that noise.
Then we'll look at the numerical ways people actually try to put a value on a business. It's sort of the science part.
But crucially, we won't stop there because valuing a business isn't just about crunching numbers.
Right.
We'll definitely explore the art, assessing all the things you can't easily put in a spreadsheet, like, the people running the company and how well protected its business actually is from competitors.
And finally, we'll talk about how you take all of this analysis, all this information, and make it work for you. How you build your own kind of framework that fits your goals.
So let's jump right in.
Okay. So at the very heart of value investing is this idea that the market price, well, it isn't the whole story. It might not even be the most important story. What's the core distinction here?
The fundamental concept, really, is separating price from value. Just think about buying anything else like a used car or maybe a house.
Okay.
There's the asking price, right? And then there's what you think it's actually worth to you based on its condition, potential repairs, the location, things like that.
Okay, so in the stock market world, market price is easy. It's just the number blinking on the screen right now.
Exactly. Market price is purely objective. It's simply where the last buyer and seller agreed to trade. And it's constantly changing because of supply and demand, economic news, investor sentiment.
Fear and greed.
Oh, yeah, often driven by raw fear and greed. It just tells you what someone was willing to pay, a second ago.
But intrinsic value, that's different.
That's different. Intrinsic value is your rational estimate, and I stress estimate, of what the business itself is truly worth,
Right.
based purely on its economic reality.
Okay, how much cash it makes. Yeah.
How much cash it's expected to generate over its entire life.
Yeah.
Its assets, its competitive strength, its future prospects.
Mhm.
It's all about the business as an operating entity,
Yep.
totally separate from the daily mood swings in the stock market.
Okay.
It's your attempt to figure out what that house is really worth based on its foundation, its structure, its earning potential, not just, what the neighbor's house sold for last week.
So the opportunity then for a value investor, it comes when the market price is way below your estimate of that intrinsic value.
Precisely. The core belief
Yeah.
is that the market isn't always efficient. Sometimes, often because of that short-term noise and emotion we were just talking about.
Mhm.
The price of a stock can disconnect, sometimes wildly, from the underlying value of the business. Value investors try to spot those situations where the market is basically offering you a dollar bill for, say, 50 or 60 cents.
So you're saying my analysis is better than the market's right now?
Essentially, yeah. You're making a judgment. You're saying, I think my estimate of this business's true worth is more accurate than what the crowd is implying with the current price. It's a bit contrarian.
But you keep saying estimate. Intrinsic value isn't some fixed concrete number then.
No, and this is absolutely critical to understand. Unlike market price, which is a fact, intrinsic value is inherently subjective. It's based on models, forecasts, assumptions, all about an uncertain future.
So different people get different answers.
Almost certainly. If 3 different analysts value the exact same company, they'll probably come up with 3 different intrinsic value estimates. It's
Yeah.
an educated guess, like she said, not a precise scientific measurement.
Okay, and because it's an estimate, because it could be wrong, this is where that really famous idea in value investing comes in, the margin of safety.
The cornerstone, absolutely. Championed by Benjamin Graham. The margin of safety just means you only buy a stock when the market price is substantially below your conservative estimate of its intrinsic value.
So the gap is the safety margin.
That gap between your estimated value and the price you actually pay, that's your margin of safety.
It's your buffer, your protection against being wrong.
Exactly. It serves two really vital purposes.
Mm-hmm.
First, and most importantly, it protects your capital. Since your intrinsic value estimate might be off, or unexpected bad things could happen to the business,
Sure.
buying at a deep discount gives you a cushion. It limits your potential downside if things don't pan out exactly as you hoped.
Makes sense. And the second purpose?
It enhances your potential returns.
Yeah.
I mean, if you buy something for 70 cents that you think is worth $1, and eventually the market comes around and prices it closer to that dollar,
If you make more money.
you've made a significant gain just from that gap closing, just from the price moving towards the value you estimated.
So how do you actually use this margin of safety? Is it like a fixed percentage off your value estimate?
Well, it's not fixed universally, but you define a required margin before you even think about buying. So if you estimate intrinsic value as, say, $100 a share, and you require a 30% margin of safety,
Your buy price is $70 or less. Right.
$70 is your target. Sources often mention ranges like 20–30% as pretty typical. But, famous investors like Warren Buffett have historically demanded much larger margins, sometimes 50% or even more.
And the size of the margin you need, that depends on the business itself, right? Not just a number you pick out of thin air.
Absolutely. This is where the qualitative judgment starts to really blend with the numbers. For a very stable, predictable business with super consistent cash flows, think like a boring utility company.
Yeah.
You might be comfortable with a smaller margin of safety, maybe 20%, because the future feels relatively clear, less risky.
But for a business in some fast-changing industry or one where profits jump around a lot.
Right. For a company with greater uncertainty, higher risk, maybe less visibility into the future, well, prudence dictates demanding a much wider margin of safety, maybe 40%, 50%, sometimes even more.
So it reflects the risk.
It's your protection against that higher degree of uncertainty, exactly.
Yeah.
So the margin of safety isn't just a mathematical formula. It's really a disciplined reflection of how much risk and uncertainty you see in that specific business.
Okay, so we've got the philosophy. Distinguish price from value. Always demand a margin of safety. That tells us why and when to look. Now, let's get into the how. How do we actually try to put numbers to this intrinsic value? This is the more quantitative part.
This is where we try to get systematic, yeah. We use financial data to build models, calculate metrics, things that give us estimates of value. And there are two main ways people approach this numerically: intrinsic valuation models and relative valuation.
Let's start with intrinsic valuation. These models are trying to figure out what a business is worth just on its own, right? Based on its own characteristics.
Exactly, standing alone. And the most prominent, probably the most theoretically sound, is the discounted cash flow model, the DCF.
Okay.
The core idea is actually pretty simple conceptually. A business is worth the sum total of all the cash it will ever generate in the future,
Okay.
but discounted back to what those future dollars are worth today. Because obviously, a dollar you get next year is worth less than a dollar you have in your hand right now.
Right, the time value of money. So you're projecting future cash flows way out into the future.
Yes, that's the first step. You forecast the cash the business is expected to generate over a specific period, maybe 5 or 10 years. And we're not talking about accounting earnings here necessarily.
Okay.
I mean the actual cash that's left over and available after the business pays its bills and reinvests whatever it needs to keep growing. That's often called free cash flow, or FCF.
All right, so you've got these future cash flow estimates, but how do you bring them back to today's value, like you said?
You use something called a discount rate. This rate basically reflects the required return for investing in this particular business, given its specific level of risk.
So riskier company, higher rate.
Higher risk, higher required return, therefore a higher discount rate? Yes. Which means those future cash flows are worth less today.
Got it. So project cash, pick a discount rate, and then just add them all up.
Almost. You project the cash flows for your explicit forecast period, say 10 years. But businesses hopefully operate for longer than that.
Right.
So you also have to estimate what's called a terminal value. That's the value of all the cash flows the company is expected to generate after your 10-year forecast period ends, stretching out theoretically forever.
Wow. Okay.
Then you discount both those projected cash flows and that terminal value back to the present using your chosen discount rate.
And the result of all that is the value of the business.
Yes, that gives you an estimated value for the entire enterprise, the
Okay.
whole business entity. To get to a value per share, which is what most investors care about, you adjust this total value for any debt the company has, add back cash, and then divide by the number of shares outstanding.
Hmm. It sounds very sensitive to the assumptions you make, like future growth rates, that discount rate.
It absolutely is. That's the DCF's biggest weakness, no question.
Prior.
It's often called garbage in, garbage out for a reason.
Right.
Because even small changes in your growth rate assumption or your discount rate can drastically change the final intrinsic value estimate you get.
But people still use it.
Oh, yes. Because its strength is its focus on cash flow, which is ultimately what drives business value. It forces you to think really deeply about the business's fundamental economic engine. It tends to work best for companies where future cash flows are relatively stable and predictable.
Okay. What about companies that pay dividends regularly? Is there a simpler model for those?
Yes, there is the dividend discount model,
Mhm.
or DDM. This is based on a simpler idea. The value of a stock is just a present value of all the future dividend payments you expect to receive as a shareholder.
So similar idea, but you just project the dividends instead of all the free cash flow.
That's the core concept.
Yeah.
A very common version called the Gordon growth model assumes dividends grow at a constant rate forever. So you just need the expected dividend for next year, your required rate of return, which is like the discount rate again, and that expected constant growth rate for the dividends.
That does sound more straightforward.
It is simpler to calculate, yeah. And it directly links the valuation to the cash actually returned to shareholders.
Mhm.
So it's pretty useful for mature, stable companies with a long history of paying consistent, growing dividends. Think classic utilities, some consumer staples.
But the weaknesses.
Well, the major weakness is obvious. It's completely useless for the huge number of companies that don't pay dividends at all, like many tech or high-growth companies.
Mhm.
And it also typically ignores other ways companies return cash to shareholders, like share buybacks, which can be significant.
Mm.
Plus, that constant growth forever assumption is a big one.
Okay, so those are the intrinsic models trying to find a sort of standalone absolute value. But there's another quantitative approach you mentioned, looking at how companies trade relative to each other.
Right, relative valuation. This isn't about finding one precise, correct intrinsic value. It's more about comparing a company to its peers, or even to its own historical valuation, using common financial metrics or ratios. The goal is to see if it looks expensive or cheap in context.
Like the most famous one, probably the price to earnings ratio, the PE.
The PE ratio, exactly. It's just the current stock price divided by the company's earnings per share. Simple calculation. It tells you how many dollars investors are willing to pay today for every $1 of profit the company earns.
But a PE of, say, 15, that could be high or low depending on everything else.
Exactly right. Context is absolutely everything with ratios. On its own, a PE of 15 doesn't mean much. Is that high or low compared to the company's historical average PE? Is it high or low compared to its direct competitors in the same industry?
Or the market overall.
Or the broader market, yeah. You need to see how it stacks up relative to relevant benchmarks. A fast-growing tech company is expected to have a higher PE than a slow-growth, mature manufacturing company. So 15 might be cheap for the tech firm and expensive for the manufacturer.
And what about price to book, PB ratio?
PB compares the market price to the company's book value per share. Book value is essentially the company's assets minus its liabilities, based on the accounting numbers.
So if it's below 1,
A PB ratio below 1 could potentially mean the stock is trading for less than the stated value of its net assets on the balance sheet. This metric is generally most useful for companies with a lot of tangible assets. Think banks, insurance companies, manufacturers. It's less useful for service or tech companies where the real value often lies in intangible assets like brand or software, which aren't always fully reflected on the balance sheet.
Then there's the PEG ratio. That combines PE with growth.
Yes, the price earnings to growth ratio, often associated with Peter Lynch. It takes the PE ratio and divides it by the company's expected earnings growth rate. It's a quick attempt to sort of level the playing field between high-growth stocks, which naturally have high PEs, and slower growth stocks with lower PEs.
what's the rule of thumb?
A common rule of thumb is that a PEG ratio below 1 might indicate that the stock is potentially undervalued relative to its expected growth rate.
Okay. We also see metrics using enterprise value, like EV to EBITDA. Why do analysts seem to prefer those sometimes?
Good question. Enterprise value, or EV, represents the total value of the entire business. It's the market value of its equity plus its debt, minus any cash it holds. It's like the theoretical takeover price.
Okay.
Using EV in the numerator, often combined with metrics like EBITDA, that's earnings before interest, taxes, depreciation, and amortization,
Hmm.
means these ratios aren't influenced by things like how much debt a company uses, its capital structure, or its specific tax rate.
Ah, so it's a cleaner comparison between different companies.
Exactly. It allows for a more apples-to-apples comparison, especially across companies that might finance themselves differently or operate in different tax jurisdictions.
Mm.
And something like EV sales can be useful for valuing companies that aren't profitable yet, but are generating revenue growth.
And just to round out the numbers, things like the debt to equity ratio are obviously important too for risk.
Absolutely crucial for context. Debt to equity, or DE, tells you how much leverage, how much debt a company is using relative to its equity base.
Mm.
More debt usually means higher risk, higher potential for financial distress if things go wrong.
But high depends on the industry.
Totally dependent on the industry. A utility company with very stable, predictable cash flows can safely handle much more debt than, say, a volatile software startup. So you absolutely need to compare a company's DE ratio to its peers in the same industry to judge if it's truly high or low.
And dividend yield for income investors.
Yep, dividend yield is key if you're looking for income. But be careful, sometimes a really high yield can be a warning sign. It might mean the stock price has fallen sharply because the market thinks the dividend is unsustainable, maybe about to be cut. You should always check the payout ratio too.
So bottom line on ratios, they're really diagnostic tools, right? Not automatic buy or sell signals.
Exactly. Think of them as clues, indicators. A low PE ratio by itself might just mean you found a bad business with the call a value trap. It's cheap for a very good reason.
So you use them together.
The power comes from using them in concert. Does that low PE come with decent growth prospects, suggesting a low PEG ratio too? Is the company trading below book value and also earning high returns on that book value, a high ROE? Are the debt levels reasonable compared to peers? You look for confirmation across multiple metrics to build a stronger case, to build conviction.
And using these ratios in a formal way leads to something called comparable company analysis, or comps.
Yes, comps analysis is basically a structured methodology for applying relative valuation. You value a target company by comparing its valuation multiples, PE, EBITDA, etc., to those of a carefully selected group of similar public companies, its peers.
Assuming similar companies should trade at similar multiples.
That's the core assumption, yeah. Companies with similar business characteristics, growth profiles, risk levels should, theoretically, trade at similar valuation multiples in an efficient market.
How do you pick those similar companies? That sounds like the tricky part.
It's very subjective. It absolutely is the most critical and often the most subjective step. You try to find companies that are truly comparable based on criteria like industry, business model, size, geographic focus, financial profile, maybe growth rates, and profitability. It really requires judgment and understanding the nuances of the businesses.
Okay, so once you've agonized over picking the right peer group, what's next?
You gather the key financial data for all those peer companies and calculate their relevant valuation multiples. Then you look at the range of those multiples across the peer group. You often focus on the median multiple rather than the average to avoid getting skewed by one or two outliers that might be unusually high or low.
And you apply that median multiple from the peers to the company you're actually trying to value.
Correct. For example, if the median EBITDA multiple for your comparable peer group is, say, 8x, and the company you're analyzing has $500 million in EBITDA,
Then its implied enterprise value is around $4 billion.
you might conclude that its implied EV is around $4 billion. Exactly. 8 times $500 million. This process gives you a valuation range for your target company based purely on how similar companies are being valued by the market right now.
And this seems like a big but, just because your target company is trading below that peer average multiple doesn't automatically mean it's a bargain.
Absolutely not. This is the crucial caveat with comps. If your target company is trading at a discount to its peers, you have to investigate why. Is it justified?
Maybe it's growing slower.
Maybe it's growing slower, maybe it's less profitable, maybe it has more debt, maybe its management team isn't as well regarded. Comps give you a relative benchmark, a data point, but they don't explain the market's reasoning. You need to dig deeper into the why.
Okay, so we've covered the philosophy value versus price, margin of safety, and we've dug into the science, the quantitative tools like DCF, DDM, ratios, comps. But the sources really emphasize that you can't just stop there, which brings us to the art of valuation.
Exactly. The numbers tell you what is happening financially, but the qualitative analysis, the art, tells you the story behind the numbers, the why. It's all about assessing those non-numerical factors that are absolutely essential for a business's long-term health and ultimately its value.
Like, who is actually running the show?
Management quality and corporate governance are paramount. Seriously, many top investors believe that assessing the quality, the competence, and the integrity of management is the single most important part of the entire investment analysis.
Why is it so critical?
Because a brilliant, shareholder-focused management team can navigate challenges, make smart decisions, and turn a good business into a great one. Conversely, an inept or self-serving leadership team can run even a fantastic business straight into the ground.
So how do you evaluate that? It seems so subjective.
It is subjective, but you look for evidence. You look at their track record. What's the CEO's history? The CFOs, how long have they been there? Are they good capital allocators? Do they make smart investments and acquisitions that actually create value? Or do they just chase size, empire building?
And how the business performed under them.
Definitely. How has the business actually performed market share, profitability, returns on capital compared to its competitors during their tenure? You also look for transparency. Do they communicate clearly and honestly, especially about challenges, or do they use jargon and blame others?
And you want management's interests aligned with the shareholders.
That's crucial. Are there incentives tied to creating long-term value for the owners, for you?
Yeah.
The key indicator here is insider ownership. Does management own a significant amount of the company's stock, especially if they've bought it recently with their own money? That's a powerful sign of alignment. You also scrutinize their compensation. Does it reward sustainable value creation?
And things like the board of directors matter too. Corporate governance.
Yes. Corporate governance provides essential oversight. Is the board truly independent from management? Does it have the expertise to challenge the CEO when needed? Does the company respect shareholder rights? Strong governance acts as a check on management power and generally reduces risk for investors.
Okay, so beyond management, a company needs something more structural, right? Something to protect its profits from competitors over the long haul.
Yes, absolutely. This is the concept of the durable competitive advantage, famously termed the economic moat by Warren Buffett.
The moat.
The moat. Think about it. High profits attract competition like, bees to honey. An economic moat is some kind of structural barrier that keeps those competitors at bay and prevents them from eroding the company's profitability.
Why is that so important for valuation?
Because it's what gives you confidence that the company can actually sustain earning those attractive returns and generating those future cash flows you projected in your DCF model. Without a moat, those long-term projections might just be wishful thinking, easily competed away. It validates the long-term story.
And the sources break these moats down into different types.
Yes, the research firm Morningstar, for example, identifies 5 main sources of economic moats. One is intangible assets.
Like brands, patents.
Exactly. Things like powerful brands that command customer loyalty and allow premium pricing, think Apple, Coca-Cola, or valuable patents and regulatory licenses that block competition crucial in pharmaceuticals or certain utilities.
Okay, what's another one? Switching costs.
Switching costs. This is about how difficult, costly, or just plain annoying it is for a customer to stop using one company's product or service and switch to a competitor's.
Like changing banks or software systems.
Precisely. It could be the financial cost, the procedural hassle of transferring data or retraining staff, or even just psychological inertia. Think about enterprise software like Salesforce, or even something simple like Gillette's razor and blade model. Once you have the handle, you tend to stick with their blades.
The network effect seems like a really powerful one, especially today.
Definitely. With a network effect, the value of the product or service increases for every existing user as more new users join.
Like social media.
Social media platforms are the classic example. Credit card networks like Visa or MasterCard, online marketplaces like eBay or Amazon Marketplace. Their value just snowballs as more people use them, creating a barrier for new entrants.
Then there's cost advantage. That seems more straightforward.
It is, conceptually. This is simply the ability to produce a product or deliver a service at a consistently lower cost than your rivals. This advantage might come from immense scale, like Walmart's purchasing power,
Right.
or from superior proprietary processes, maybe a unique location advantage, or better access to raw materials. This allows the company to either undercut competitors on price or just earn fatter profit margins.
And the last one was efficient scale.
Efficient scale. This applies in markets that, due to their structure, can really only support a few profitable competitors, often because the upfront investment required is massive.
Like infrastructure.
Exactly. Think of things like airports in a given region, major pipelines, railroads. Building a direct competitor is often prohibitively expensive or logistically impossible, so the existing players have a kind of natural monopoly or oligopoly. Identifying if a company benefits from one or more of these moat sources and judging how durable that moat is a critical part of the qualitative assessment.
Okay, so you've looked at the numbers, you've assessed the management team, you've identified the economic moat protecting the business, but the company doesn't exist in isolation, right?
Absolutely not. You must understand the industry landscape it operates in. You could have a fantastic company with great management and a decent moat, but if it's stuck in a structurally terrible industry with brutal competition and declining prospects, it's still going to face serious headwinds.
And Porter's Five Forces is a classic framework for analyzing that industry structure.
Yes, Michael Porter's Five Forces framework is a really useful tool for understanding the underlying profitability potential of an industry. It helps you diagnose the competitive intensity.
What are the forces again, briefly?
You look at the threat of new entrants. How easy is it for new competitors to jump in? Are there high barriers to entry? Then there's buyer power. Can customers easily push prices down? And supplier power, can the companies that supply your target raise their prices easily? Then the threat of substitutes, are there alternative products or services that could lure customers away? And finally, the intensity of rivalry among the existing players already in the industry.
And you want an industry where these forces are weak?
Ideally, yes. An attractive industry for investment is typically one where entry barriers are high, buyers and suppliers have limited power, there aren't many viable substitutes, and the rivalry among existing competitors is relatively moderate, maybe based on features rather than just price wars.
And the industry's stage of development matters too, like growth versus maturity.
That's also key context. Industries tend to evolve through a kind of life cycle. There's the introduction phase, new, uncertain technology, the growth phase, rapid expansion, lots of players jump in, then maturity, growth slows, competition intensifies, there's often a shakeout and focus on efficiency, and finally decline. Sales start falling, companies might consolidate or exit.
And that affects expectations.
Absolutely. A company's realistic growth prospects, its investment needs, and the types of strategies that make sense will be very different depending on whether it's operating in a rapidly expanding growth industry or a slow-moving, mature one. You wouldn't, for instance, realistically expect hyper-growth from a company making buggy whips, right?
Right. Okay, wow. So we got all these puzzle pieces. The quantitative analysis, the qualitative assessment of management, and the moat, the understanding of the industry context. Now for what seems like the most critical step, putting it all together, synthesis.
This really is where the art and the science truly have to merge. You need to construct your investment thesis. This isn't just a collection of facts and numbers. It's the coherent narrative, the story that explains why this specific investment is attractive now, supported by all the evidence you've gathered.
It's the why buy this stock argument.
Exactly. It's where you connect the dots.
Yeah.
It's not enough to just say the PE ratio is low. Your thesis needs to explain why you believe the PE is low. Sure, gee, the market is overlooking temporary issues or underappreciating the moat, and why your own intrinsic value estimate is more reliable. For example, because of the strong management, the durable competitive advantage, the favorable industry trends you identified.
So the qualitative findings the art have to actually support and make sense of the quantitative assumptions you made in the science part.
Absolutely critical. Does the company's powerful brand loyalty or strong network effect actually justify the high growth rates you plugged into your DCF model? Does the stability of its industry mean that its debt levels, which looked maybe a bit high in isolation, are actually quite manageable? Does the CEO's proven track record give you real confidence in their ability to execute on future plans? The qualitative factors provide the reasons to believe that your quantitative model might be more accurate than whatever view is currently embedded in the market price.
Interesting. The sources also mentioned a technique called the reverse engineered DCF. That sounds like kind of flipping the script on the normal DCF.
It is, in a way. Instead of starting with your own forecasts of future cash flows to arrive at an intrinsic value estimate, you start with the stock's current market price. Then you work backward through the DCF formula to figure out what assumptions about future growth and profitability the market must be implicitly making to justify that current price.
So the question becomes, what growth rate is already baked into this stock price?
Exactly. What does the market think this company is going to do? And your investment question then transforms into, given my deep understanding of this business, its moat, its management, its industry prospects, Is that market implied growth rate realistic? Is it overly optimistic? Or is it actually surprisingly conservative?
So it helps assess the
It
odds.
helps you frame the bet you're making. It shifts the focus from what's my price target to what do I have to believe about the future for this stock to be a good investment at today's price, and how likely is that belief? It's a really useful reality check.
Okay, so beyond all this incredibly detailed analysis of the company and its industry, the sources stress you also have to bring it back home, right? Back to yourself.
Fundamentally, yes. All the brilliant company analysis in the world is frankly useless if the resulting investment doesn't actually fit your personal financial situation, your goals, your temperament. You have to filter everything we've discussed through your own unique personal framework.
And what makes up that personal framework? What are the key pieces?
It really boils down to three key things: your personal investment philosophy, your time horizon, and your risk tolerance.
Okay, philosophy first.
Your philosophy is your set of core beliefs about how markets work, what drives returns, what kind of investor you want to be. Are you primarily focused on value, growth, income, or some blend? Having a clear philosophy acts as your North Star. It guides your strategy and, importantly, helps protect you from chasing the latest investment fads or panicking during market turmoil.
Time horizon seems incredibly important, maybe the most practical factor.
Arguably, yes, it's the most critical practical factor. It's simply, when do you actually need this money back? If you're investing for retirement that's 30 years away, you have a very long time horizon.
So you can take more risk.
You can afford to take on more risk, ride out market downturns, and focus primarily on long-term growth, likely favoring stocks. But if you need the money for a house down payment in, say, 3 years, your horizon is short. Capital preservation becomes the absolute priority. You need to be much more conservative, focusing on safer assets like bonds or even cash, because you just don't have time to recover from a big loss.
And risk tolerance.
Yeah,
That's about how comfortable you are with the idea of losing money.
it's partly that, yes, your willingness to take on risk, which is about your emotional comfort level. How would you feel if your portfolio dropped 20%? But it's also about your ability to take on risk, your financial capacity. Can you actually afford to lose a chunk of money without it derailing your essential financial goals or your life?
So it's both emotional and financial.
Exactly. It requires a really honest assessment of both your psychology and your financial reality. The goal is to construct a portfolio and a strategy that you can actually stick with, psychologically and financially, even when the market inevitably gets scary.
So thinking about this, your personal situation, goals, time, risk, that actually dictates the big picture strategy first, before you even pick individual stocks.
Yes, this is a crucial distinction. There are really two levels of investment decision-making. First is asset allocation. This is the top-down, strategic decision based only on your personal factors: goals, time horizon, risk tolerance. It answers the question, what percentage of your total investable money should go into broad categories like stocks, bonds, cash, real estate, maybe alternatives?
Okay, that's step one.
That's step one, the strategy. Step two is security selection. This is the bottom-up, tactical decision-making based on all the rigorous company analysis we've been discussing. It answers the question, which specific stocks or bonds or funds should you choose to fill up that stock allocation percentage you decided on in step one? Your personal framework sets the overall strategy. The company analysis helps you execute the tactics within that strategy.
All right. We've done the analysis, we've built the investment thesis, we've figured out where it fits into our personal plan. Now comes the moment of truth, making the actual decisions: buy, hold, or sell.
And discipline here is absolutely key. Your decision to buy should be mechanical, based on your predetermined criteria.
Price hits the target.
The market price must be at or below your calculated intrinsic value estimate minus your required margin of safety. If it is, you buy. If not, you wait. You try to ignore the hype, the fear, the daily chatter. You buy based on your analysis and your preset price target.
Okay, and when do you hold? Just forever?
You hold as long as your original investment thesis remains valid. That's the key. You should periodically review the company's fundamentals, read the quarterly reports, listen to earnings calls just to make sure the business is performing roughly as expected, and critically, check if that economic moat is still intact.
But ignore the daily price swings.
If the underlying business is sound and your thesis still holds true, then yes, you generally ignore the short-term price volatility. Let the weighing machine do its work.
Okay, and finally, sell. This seems just as important as buying right. When do you sell using this value-focused approach? It's not just when the price goes up, right?
Right. Selling requires just as much discipline as buying. There are generally only three valid reasons to sell within this framework. First, Full valuation. The stock price has risen and now meets or even exceeds your estimate of its intrinsic value. The significant undervaluation is gone, the margin of safety has disappeared. It's time to realize your profit and perhaps look for other, more attractively priced opportunities.
Makes sense. What's the second reason?
Second is opportunity cost. You've done the work and found a significantly more compelling investment opportunity elsewhere. Maybe a company that's much more undervalued, offering a much wider margin of safety. If the potential return from the new idea is substantially better, it might make sense to sell the current holding even if it hasn't reached full value yet, to free up capital for the better opportunity.
Okay, valuation and opportunity cost. What's the third reason to sell?
The third, and often the most painful, is thesis impairment. This means the original reason you invested in the first place is no longer valid. Something fundamental has changed for the worse.
Like the business deteriorated.
Maybe the company's underlying fundamentals have permanently deteriorated. Maybe its competitive advantages, its moat, have been seriously eroded by new competition or technology. Maybe there's been a major management blunder or ethical lapse. Or perhaps you just have to admit that your initial analysis was flawed. The original story is broken.
And crucially, you don't sell just because the price dropped if the business is still okay.
That's the critical discipline point. You don't sell just because the stock price has fallen, especially the underlying business remains strong and your original thesis is still sound. In fact, a price drop in a still good company might even be an opportunity to buy more, assuming you have capital and conviction. Selling should be driven by changes in value or fundamentals, not just price action.
Wow. That is a remarkably comprehensive framework, really, from understanding that fundamental idea of value versus price to building in that safety net with the margin of safety, using numbers like DCF and ratios as tools, but knowing their limits.
Right?
Then layering on that crucial art of understanding the business quality, the management, the moat.
Yeah, the qualitative side.
And then finally integrating all of that with your own personal situation, your goals, your timeline, your risk tolerance to make disciplined buy, hold, and sell decisions.
It really gives you a roadmap, doesn't it? A way to try and navigate the often chaotic market with a focus on the underlying business reality rather than getting swept away by the daily market noise.
And doing all this analysis, executing this framework, obviously requires digging into the actual data, the sources mentioned where people can find this stuff.
Yes, absolutely. For U.S. public companies, the undisputed gold standard primary source is the SEC's EDGAR database. That's the electronic data gathering, analysis, and retrieval system.
Sounds official.
It is. It's where companies are legally required to file all their official reports. The big annual report, the 10K, the quarterly updates, the 10Q, reports on significant current events, the 8K, proxy statements for shareholder votes, and reports on insider trading by executives and directors.
The 10K is the big one.
The 10K is particularly valuable. It contains incredibly detailed descriptions of the business, its strategy, its markets, identifies key risk factors, provides detailed financial statements, and includes the crucial management's discussion and analysis, or MD&A, section where leadership talks about performance and outlook.
Reading those documents sounds like a pretty deep dive in itself.
It definitely can be. They're often long and dense, but they contain the unvarnished truth directly from the company without the media spin. Fortunately, though, for individual investors today, there are also many excellent free or low-cost resources online that aggregate all this SEC data and present it in a much more user-friendly format.
Like what kind of sites?
Popular financial websites like Yahoo, Finance, Google Finance, Morningstar. There are also more data-focused platforms like Koifin or TIKR that offer really powerful screening and analysis tools, often with generous free tiers. These tools make accessing and analyzing the data much, much easier than it used to be, say, 20 years ago. They democratize the information.
So you've got the framework we discussed, you've got the analytical tools, both quantitative and qualitative, and you know where to find the source of truth for the data in those filings or aggregated online.
All the components are definitely there for you, for anyone really, to start performing this kind of fundamental, value-oriented analysis if they choose to put in the effort.
Wow, okay. We have really gone deep into these sources today. I feel like we covered a lot of ground. We started with that core fundamental idea that market price isn't the same as intrinsic value, and why that margin of safety is, well, maybe your best friend in investing. We explored how numbers, things like discounted cash flow, dividend models, all those valuation ratios can help you estimate value while always understanding their limitations and assumptions.
The science part.
The science part. Then we looked at the essential art judging management quality, identifying the power of an economic moat protecting the business from competition.
The qualitative overlay.
Right. And finally, we brought it all back to how you, the individual investor, can synthesize all this analysis into a coherent thesis and make disciplined buy, hold, or sell decisions that are aligned with your own personal goals, your time horizon, and your tolerance for risk.
It's really about shifting your mindset, isn't it? From being just a passive price watcher, reacting to the market's whims, to becoming more like an active business owner, even if you just own a tiny piece of the company through its stock. Thinking like an owner.
Exactly. Understanding what you actually own.
Precisely. That's the goal.
So here's maybe the final thought to leave you with today. Benjamin Graham, often called the father of value investing, he famously said that in the short run, the market is a voting machine driven by popularity, sentiment, headlines, votes. But in the long run, he said, it's a weighing machine. It eventually recognizes and reflects the true underlying weight, the substance, the value of the business itself.
A weighing machine.
This deep dive hopefully has shown you some ways to do the weighing. The real question is, are you ready to try and ignore the noise of the voting machine crowd and trust your own judgment based on careful analysis and understanding the business?